The SIM Value Fund has been one of the top performing equity funds in South Africa over the last 10 years. Part of the fund's success can be attributed to the long-term pragmatic value approach the fund takes to investing. And this approach often means the portfolio will hold unpopular and unloved shares that at first glance appear repulsive, but over time prove to be good investments. Joining us from Cape Town to give us more on the portfolio construction is Claude van Cake from Sanlam Investment Management's Unconstrained Performance. Thanks so much. Warren, you're going to take it again.
Yes, Bronwyn, I think we've been very fortunate this week. We've profiled some great funds and some great fund managers. And this is another one. You can see this is the 10-year performance, a rolling 10-year performance of the SIM Value Fund, which now sits in the Unconstrained Capital Partners. And you can see here, relative to its peers, starting in December 08, it's been ranked within the top 5 funds in its category over a rolling 10-year period up to 31st of December last year. If we look at the next slide, you can actually see the dramatic effect. While on a year-to-year basis, the increase might be just above its benchmark, like the all-share index or its peers in the domestic equity funds. If you look at it over a long period of time, you can see the massive difference that investors have, and this is over just a 12-year period going back to September 98. The investors have almost an order of magnitude in terms of the value that they will accrue because of a decision around the investment managers they chose. So I think we want to ask Claude a little bit about the way they're doing this, and specifically how it's going on the foreign front, where they've allocated about 25% of the fund to offshore equities.
Well, Claude, you've been set up there, great track performance, and we're looking now for your secrets, where you will share them with us. So.
Okay, thanks, Bronwyn. And look, from an investment point of view and an investment philosophy point of view, we are active long-term value managers. So from that point of view, our objective is to exploit the inefficiencies that exist within the market. And there are 2 key issues that we need to exploit over time. And the first issue is the long-term investment approach that we take. Unfortunately today, many investors are very short-term oriented. They like to look at short-term news flow and make decisions on that basis. And we believe you can exploit this time horizon factor in the market. And I think the second big factor that one needs to be able to exploit are the behavioral biases that exist in the market. And that's this issue of fear and greed. And in the short term, there could be a lot of negative news flow that could be in certain stocks, which could result in them underperforming in the short term, but that creates very good long-term investment opportunities for us.
Claude, you've got, you said to me earlier on the fund that you'd allocated about 25%, the full amount that you can take to offshore equities. We've seen many of your peers taking that money and investing in very large cap companies, the Johnson & Johnsons of the world and the IBMs. I'm intrigued to just find out where you've been seeing value, if it is in that large cap space, and if that's so, why are you finding value there? These must be covered companies that are covered by hundreds of analysts and portfolio managers. Why are they being neglected if that's the case? Sure.
Warren, our approach to the international allocation of assets, at the moment we've got approximately, call it 20% of our capital in the value fund allocated offshore. I've indicated in the past we see a lot of relative value there. And the approach that we would take is to buy good quality companies that people know and understand in sectors that we have analyzed, that we've covered over long periods of time, so that some of the companies that we invested in currently are the likes of a Tesco, a Vodafone, and maybe to chat a little bit about that, we can buy international assets now, the likes of a food retailer like Tesco in the UK, on low PE multiples of 10 times with 5% dividend yields. And you compare that to what you're paying in South Africa for the likes of ShopRite, close on 30 times PE multiples. There's a huge discrepancy in value. And I think a couple of points to highlight there. Clearly the UK and Europe is under a little bit of stress in terms of growth, but we think that's largely priced into many of the stocks. You look at Tesco and they're operating, although 3/4 of their profits might come from the UK, the 25% allocated offshore are generally in growing markets. You're looking at South Korea, you're looking at at the expansion into the States, where they've got very low market share currently. And again, there are growth opportunities for them, and you're paying very low multiples for that. And if I look at the likes of a Vodafone, for instance, Vodafone's also trading on 11 times PE multiples with 5.5–6% dividend yields. And although again the growth outlook is fairly muted in the shorter term, you're not paying excessive multiples. To compare that to what you're paying for a Vodacom currently in the South African market, you're paying 15–16 times multiples for that.
Claude,
so again, there are a lot of relative value opportunities offshore.
MTN stands out for me as one of your big holdings here, some 5% of the fund. And if you look at MTN, it's trading at all-time highs, around about 180 Rand. When does the unloved stock in your portfolio become ready to get out of? I mean, when do you take your money and run, to put it quite bluntly?
Sure. No, I think that's a good question, Bronwyn. The problem is most stocks are reaching all-time highs on the South African market, which is obviously a little bit of a concern. But you're right, MTN is reaching new highs. Having said that, again, you look at the growth outlook for the business, which we think is fairly reasonable, given the sort of price that you're paying for it. So from a multiple point of view, you're paying multiples of around about 14 times for a stock that we believe, if you look at Nigeria, where penetration rates are still relatively low, around about 60–65%, I'm talking about mobile penetration, and you compare that to South Africa, which is now well above 100% mobile penetration. And then if you look in the developed world, where penetration rates are well above 150%. So there are still a lot of growth opportunities, not necessarily within the South African part of their portfolio, but certainly within the African part of the portfolio. So we still see a reasonable outlook. But to answer your question, when would we sell out totally? When we look at valuations, we look at a base case fair value for a stock based on conservative assumptions. We then look at a best case. So if things go really well for a business, what's the best case? And then clearly a worst case on the downside. When a share gets to our best case assessment of its fair value, as value managers, we will be out and we will sell out entirely. We're not there yet with MTN, in our opinion.
Claude, MTN does raise an interesting point, and it's one, we talk to the ESG guys that come onto the show fairly often. Governance factors are very important in companies, I'm sure, that you look at. MTN went through a process last year where they had the Lord Hoffman inquiry or commission that looked into their dealings with the Iran tender. We're seeing a similar story unfolding in the construction space at the moment with tender rigging and I guess collusion. What's your sort of approach when you see companies that may look very cheap, but they are cheap because there are some significant clouds around their name at that point? How do you approach that from a governance perspective?
Warren, we take corporate governance very seriously. We think it's an extremely important part of your investment case. As we've said before, we allocate capital to manage, well, at least from a management point of view, they are the decision makers in terms of capital allocation on our behalf. So if we can't trust management, it makes our job incredibly difficult. So the first point is we regard that very, very highly. If we go back to the MTN scenario, I think MTN were very proactive in engaging with shareholders. We had engaged with them directly regarding these issues surrounding the Hoffman due diligence, if you like, on their activities and what was happening in Iran. And they were very clear that they would take an independent sort of approach to this to ensure that everything is above board. I think they've gone down that route. I think the initial indications that have come out from the Hoffman report are certainly very positive and a welcome relief from our point of view. Because you need to trust management in terms of their general corporate governance. So, we also took a very active approach in engaging with management on this particular issue. And, I think it's not over yet. There's still a few issues that probably have to, come through the US courts if it ever goes to the US courts. But I think what's come out currently is very much in their favour, and it tells you that a lot of things that management have done have been very much above board, and we are very comfortable with the corporate governance of the likes of MTN.